My name is Harnil Soni from Shah and Company. I am here to discuss a very interesting topic which affects every investor, entrepreneur and every single person who is interested in Indian stock market. How the IPO ecosystem works in India and how we can earn more returns from investing or not to invest in a particular IPO. Now let's start with an interesting statistic. What do you think? How much money has been raised through IPOs in financial year 25-26? 50,000 crores? 1 lakh crore? No, but the actual figure is 1.6 lakh crores and counting, which may also be raised to 2 lakh crores as per the estimates. As you all may think that the Indian IPO market is at boom, but now comes the harsh reality. Out of the 90 IPOs being listed in financial year 25-26, approximately 30 to 35 IPOs are being traded at a price lower than their listing price within a short span of listing, which means that out of 1/3 IPO, the general public is losing their money, which may also have an adverse effect. The major reasons for that are, at the initial phase of 2025, there was a bull run in India, and major companies have taken advantage of it, and they have inflated their profits manifold times. They have also shown the profit or notional profit which does not have occurred, and they also overvalued their shares, and due to this the major public have lost their money. While all this goes, what do you think? What is an IPO? An IPO stands for initial public offering. It is a process through companies get their shares listed on an IPO and the general public can easily buy them. IPO is also an opportunity for general public like us, which help us to invest in a company which has a higher growth prospect in their initial stages. The more important question than what is an IPO is why companies go public. One of the major point is capital raising. IPOs act as a primary vehicle for companies to raise substantial capital, which can be used by them for their growth, tech development, and also for other major prospects. Debt reduction. Companies may also use their IPO funding to reduce their debts, which helps them to reduce their interest cost, which also helps in their financial and operational efficiency. Shareholders liquidity. An IPO provides a mechanism for early investors or promoters to monetize their stake, offers liquidity to them, which can be also done through offer for sale. IPO also helps companies to increase their visibility. A more visible and a traded company on stock exchanges have better public presence, and due to this, they can also get major partnerships from MNCs, or they can also get merger and acquisition proposals. Now comes the major chunk of the discussion, where the funds being utilized, whether for the fresh issue. Fresh issue refers to the capital raised directly, and it also gets utilized for the company's growth only. There is a general or positive indicator. Major the funds are used for fresh issue, the more the chances the company grows. Offer for sale. In an offer for sale, the existing shareholders typically get their stakes laid off or try to exit from the company. Then due to this, the promoters are there. Also, there may be a prospect that the promoters think that their company is not growing well if the proportion of offers for sale is major. We have also to check whether the company's valuation is proper or not. If the company is having a major premium, is adding a little premium over the existing value or intrinsic value, it is good for the company's growth. But if effective or major, or they are having a higher valuation than their intrinsic value, it is also a red flag for them. A company with a little premium can gain or have better sale. The intrinsic value can also be calculated by the PE ratio, price to sales ratio, discounted projected cash flows, called industrial multiples. Business and financial health check, business indicators. one of the major check for business are TAM. TAM refers to the total addressable market in which the company is dealing. If the company's TAM is more or their market share is higher and also the TAM is increasing at a growth rate of 12 to 15%, it is also a good benefit. Competitive landscape. If the competitors are less and they can do competitive landscape. In this, they also check who are their competitors, what are their strengths, what are their weaknesses. And if the company also has a competitive advantage over their companies, like better tech, customer loyalty, and higher cash flows, or proper control over their cycle. Financial indicators, revenue growth. If a company is having 15 to 20% growth annually, it is a high chance that the company's profitability, if they are even in loss, they can also become profitable in next 1 to 2 years. EBITDA margin. EBITDA margin refers to the company's operational efficiency. Whether that operational efficiency is good or not. The EBITDA margins are good depending on the sector. Like in software and IT sector, their EBITDA margins are generally from 30 to 60%. Whereas in e-commerce and retail trade, the EBITDA margins are just 2 to 8%. There are no standard benchmark for which we can tell that whether the company's EBITDA margins are good or not. Debt to equity. If the company's debt is not much higher than their equity, it can also be taken as manageable. If their equity is high, cash flow operations, the company can easily manipulate their profits, but there is a very less chance that the company's profit cash flows can be manipulated. If the cash flows are good and consistent growth having, we can easily invest in a company. If the cash flows are consistently negative or decreasing, it is also a red flag. Management quality and governance. If the promoter's stake in the company after IPO is good or substantial, then we can also tell that their investment in good or they are also having higher growth prospects. Related party transactions. If the company is having related party transactions, we have to check whether they are being done at arm's length price or not. Or if there are multiple related parties and their transactions are being complex, it is difficult for us to analyze whether they are being at arm's length price or not. Then we should avoid investing in such companies. Board's independence. We have to evaluate the composition of board of directors, whether they are being independent or not of the promoters. If yes, it is also a good flag. Now let's discuss about the red flags. If the company is having a sudden profitability in the ratio from last 1 or 2 years, then this can also be done through one-time adjustments or aggressive revenue recognition. This means that the company is just showing a profit for the sake of getting funding. For us, retail investors, it is a red flag because a sudden profitability is a disaster than a low and consistent profit. We should always try to get an investment in company which does not have a sudden but a steady growth rate. And also the cash flows are increasing complex group structure. If a company's group structure is very complex, it is also a red flag. We cannot easily trace whether the funds are being flowed. There are major chances that the funds are being misutilized. Auditor's recognition. Auditor's resignation. There are many chances that the auditors may resign just before the company's IPO. The major reasons for that are they are consistently changing accounting policies just to show their higher profitability, or they are not getting proper disclosures. For us, retail investors, the basic strategy is just not to follow the hype for the company or the grey market premium. The grey market premium can be easily manipulated by the promoters to get the more funding. We should make a sensible decision by not just checking the grey market premium, which most of the persons does. We should make a study of the fundamental analysis of the company, and we should make our own stand and not by just taking any tips from our friends or family.